I remember taking the family to Yellowstone. My twins were maybe 10 years old. By the way, when your kid pukes in a tent at about 3 a.m., that ain't fun. But that's not what this particular story involves. Whole different story here. So I'm at Yellowstone with the family, and I remember listening to this park ranger tell us about forest fires. And he talked about how the pine cone on these trees, on many of the trees around Yellowstone, needed to experience some very severe heat to actually open up. So many of the trees in Yellowstone actually rely on fire. They rely on it to cleanse and to create new life. And that, kids, is an analogy for capitalism. Live from the 3-room apartment above Uncle Jack's garage while the basement is being renovated. Welcome to Money in the Morning. Hey there, kids. I'm Joe Saul-Sehy, Average Joe Money on Twitter. And this is the show where we take not one, but two financial headlines ripped from the financial press. And we not only read them like some shows that go halfway do, but we take it to the next step, which is we actually talk about what they might mean to your wallet. And today, we're talking stock plunging. We're talking bankruptcy when it comes to a big retailer that you may or may not have heard of. It's going to be a fun show. And this fun show is brought to you today by Tiller. Tiller is your financial life in one easy to follow spreadsheet, automatically updated every day. 83% of Tiller customers say they're more aware of where their money's going. By the way, those other 17% of people, how do you not use a tool like Tiller and you're not more aware of where your money goes? I don't know. You can check it out for free. StackyBenjamins.com/Tiller. And even though I said the S word, spreadsheet, it's a ton of fun because you can either make it easy or make it uber complicated. It's up to you. And just go there and check it out. StackyBenjamins.com/Tiller. We'll talk more about Tiller later in the show. But for now, we got some headlines. So let's get this party started. Laura?
Here come two headlines ripped from the financial press, only at Money in the Morning.
I love the comment somebody said a few weeks ago. Why do they have to be ripped from the press? Like that seems, well, why can't they be gently grabbed from the press? Good point. But today we're ripping this one from MarketWatch, and this piece is written by, William Watts, Deputy Market Editor over at MarketWatch. And by the way, I'm a big fan of William Watt's work, and I'm also generally a big fan of MarketWatch, but we have to award this award that we haven't done in a long time, and I'm very excited to award it. Richie, it has been forever since we've given this award out. This, ladies and gentlemen, is
the dumbest headline of the week.
Yes, dumbest headline of the week is this particular one. I read this and went, really? Are you kidding me? In my opinion, what a waste of space, which means we're going to talk about it now for about 10 minutes. Oh, it's a waste? Let's focus on it. William writes this. This is the headline. Stock market plunges really do happen much more often, this chart shows. I feel like we're talking about like weather conditions or global warming. Global warming for stocks is maybe what this piece is. Maybe investors should be getting more accustomed to stock market plunges akin to those that rippled through the markets in the last couple of weeks, knocking more than 830 points off the Dow Jones Industrial Average in one day and leaving the blue chip gauge and the S&P 500 with their worst decline since February. They may also take comfort from history, which also indicates that when they occur, a market bottom usually isn't too far away. Once again,
the dumbest headline of the week.
Really? A market bottom not too far away. Okay. Let's keep reading. Quote, if sudden market plunges out of nowhere seem to be happening more frequently than in the past, it's not just you, wrote the equity derivative strategist at Wells Fargo Securities in a Monday research note. Such sudden burst of volatility have become more frequent in the past few years, he said. So we've had two this year, February and now. 2016, we had the Brexit issue. In 2011, we had one. And then, of course, if you guys remember 2007, we had one. Before 2007, it goes back to 1998 before we had this sudden day. By the way, what makes this
the dumbest headline of the week
is that it doesn't include 2000 to 2002. It also doesn't talk about broad downturns, which is far more what we're worried about than a single day. The higher the stock market goes, the more we should think that there's going to be stock market downturns. Or we should think that. I mean, call me crazy to think that as we have a market that goes up and up and up and up, every once in a while, the market's going to shake. And as we've had this long upswing, it's going to shake a little more. And what's funny is that without those big days, if you took those big days out, if you look at the VIX, which is the volatility indicator of the stock market, the VIX has been like a dead person's heartbeat. I mean, the VIX until just lately has been absolutely dead. So when it comes to overall volatility, okay, we've had some stock market plunges, but don't those just make up for the fact that volatility has been at these near lows? I mean, come on. It's so, it is crazy. I get angry about pieces like this because stock market plunges happening more often. Last year, the stock market just was an escalator ride up. And we should be ready for stock market plunges. We should be ready for big time volatility. Forget this one day junk. Worrying about one day is crazy. You look at people that got mixed up in Brexit, and people sold during the Brexit. What was it? 3 days? People sold during that time and they ruined everything for themselves. People online in forums that I read recently, people asking, what should I do? What should I do? Not a great time to be creating your strategy now. It's a horrible time to be creating your strategy. When you look at professionals go in to any relationship with a client, and they will have something called an investment policy statement. Investment policy statement means this is our policy. This is how we manage money. This is the system that we use to manage money. If you're going to manage money for yourself, you should develop an investment policy statement. This is how I act. This is when I look at it. This is when I don't look at it. Create a policy. And then instead of wondering what happens when the market goes down, then you're tweaking your policy to make your policy better. And that's all you need to do. It's absolutely crazy. Generally love William Watt's work. I think that this was okay. It's a fun piece to take a look at single day volatility and why markets go down, but still qualifies. We haven't had one of these in a while.
The dumbest headline of the week.
We've probably had one a month ago, maybe 5 weeks ago. So it was about time that we had one. So congratulations. We finally have a winner, and MarketWatch is you. Let's say hello to all of our friends hanging out with us on Facebook today because we do this live in front of a Facebook audience. Kevin says MarketWatch has to sell ads. Yes. And we have to feed the beast, right? We have to write about something. So there it is. And Kimberly's here. Hey, Kimberly says it's only a loss if you sell while it's down. I told that, and during these spiky, I like that word, spiky downturns, there's no reason to sell or to doubt your strategy. Shireen and Paul are here. Hey guys, Adam is here. Bethany's here from the Money Millhouse podcast. We've got John here hanging out over lunch. Kurt is here. So nice group of people. Thanks for playing with us today, guys. By the way, if you want to be in our live Facebook audience, head to facebook.com/iStackBenjamins, and we show up at random times. And like today, we didn't announce we were coming. We just, ta-da, we're here. And it's your lucky day that you get to sit and hang out with us. I know how exciting that is for everybody who's in our Facebook group. Sean just arrived. Hey, Sean. You made it at the halfway mark. We're happy you're here with us. All right, let's move on to our second piece. By the way, our takeaway there from piece number one is a very simple one, and that is probably not. Stock market plunges happen more often, offset by incredibly low volatility when it's not plunging. So take that for what it's worth. Next headline comes to us from CNN Business. I don't know if you noticed this, but Sears went bankrupt. How about that? Boy, we haven't talked about Sears a lot, he said, tongue firmly in cheek. We've talked about Sears. Like, if you could talk about a company and all the things not to do, I think Sears could fill a book there. I love Sears for that reason. I also love what was the video store? Blockbuster. Another thing not to do. Look at Sears and Blockbuster, and you could fill college textbooks of what not to do. But no shock that Sears went bankrupt. CNN Business has a follow-up piece, though, here by Paul LaMonica. Landlords across America are cheering Sears bankruptcy. How about, you would never think, especially you look at these malls around America, now you got this huge big box store at the end of the mall that's empty. So what's going to happen then? Well, let's read on. Let's see why they're actually cheering. Landlords are telling Sears, don't let the door hit you on the way out. Kimco announced Monday morning it was looking forward to getting new tenants into the spaces soon to be vacated by Sears and Kmart stores. The real estate investment trust based in New Hyde Park, New York, has leases for 3 Sears locations and 11 Kmarts. Sears announced last Monday that it would close 142 stores before the end of the year. Those closures are a, quote, long-awaited opportunity, said Connor Flynn, CEO of Kimco, in a statement. He said he looks forward to several new redevelopment opportunities after Sears and Kmart vacate the premises. The average rent for the 14 Sears and Kmart stores was $5.25 per square foot, Kimco said. That's well below the average of, get this, $15.95 per square foot for other Kimco properties. Only 1/3 the rent they're getting from other places. Sears signed decades-long leases on many of its real estate deals, giving its stores extremely favorable rent contracts. And yet, by the way, if you remember a couple weeks ago, we were talking about Sears saying that it was having problems with some of its rent contracts. Stores in Los Angeles, Miami, and Long Island's affluent Hamptons area are plum opportunities for new retail tenants, according to Kimco. Another real estate company, Seritage Growth Properties, expects to lease Sears and Kmart locations to new tenants at significantly higher rates. Seritage said it has historically gotten about 3.5 to 4.5 times more in rent by releasing space once occupied by Sears. Seritage was set up in 2015 primarily as a landlord for Sears and Kmart stores. The company has been busy shedding its exposure to Sears. About 70% of its lease income now comes from non-Sears tenants, CEO Benjamin Shull noted in a press release on Monday. That's up from just 20% when the company was formed 3 years ago. Seritage tried to put a positive spin on Sears bankruptcy. It said the company has about $1 billion in cash, thanks to a loan from Warren Buffett's Berkshire Hathaway, which will help it complete new projects, even if Sears were to stop paying rent. Property owners largely agree they'll be better off without Sears and Kmart. One real estate company was painfully blunt about the possibility of Sears filing for bankruptcy and perhaps going out of business. Washington Prime Group, a real estate owner that got about a 1% of its rent from Sears as of the third quarter of 2018, blasted the company for its many missteps. Quote, tenants which have failed to evolve in order to satisfy an increasingly savvy consumer don't belong in our assets, said Washington Prime Group CEO Lou Conforti in a press release last Friday. Conforti added that the company now has 47 fewer Sears locations in its portfolio than it did 3 years ago. In an unusually harsh critique from a public company CEO, Conforti mocked Sears for being a company hopelessly lost in another era. Nobody should be surprised by the Sears bankruptcy, quote, unless they own a few Zayre, haven't heard the word Zayre in a while, unless they own a few Zayre or EJ Corvette locations trapped in a space-time continuum where the Sansa belt clad relax on shag carpeting illuminated by the warm glow of a lava lamp while they drink Tang and vodka and listen to the Moody Blues, Comforty said. Ouch. And listen, there's nothing wrong. Is there anything wrong with the Moody? Richie, do you even know who the Moody Blues are? Richie has no idea who the Moody Blues. That's so sad. It's unbelievable. Nothing wrong with the Moody Blues. I can't believe lava lamps. Okay, I get that. Drinking Tang, I get it. But lava lamps? It's a whole different thing. Adam says here, Kmart's also dying off. Kmart's dying because they're part of the same company, Adam. So when Sears went bankrupt, Kmart's bye-bye, gone too. So they are part of the same experience. Let's talk about the big deal here because there is a big deal. And this is what I think is so fascinating. We talk about a lot here about following the way that companies manage their money to get clues about how to manage your own. And the more that you spend your time and energy thinking as if you are a company CEO, company CFO, the better you're going to be about making fewer emotional decisions. And the place that you see people get caught up is they make very emotional decisions about their money. And look at these real estate companies that were renting to Sears and to Kmart and how they're coming out saying this is fantastic. But you can't say it's fantastic until you know what the next thing is beyond what you're doing now. The fact that they could get triple the money that they're getting now. You know why they know that? Research. They also know that because they've diversified into other areas. So knowing not just the game you're playing today, but the game that you could be playing, the next game, is an important part of your plan. And things go wrong all the time, right? It doesn't have to be Sears where you could see why this company went bankrupt from a mile away. It doesn't have to be like that. It can be something that just messes up. And by having that plan ahead of time, that contingency plan of what you're going to do if things go poorly is an important part of your overall plan. In fact, I have a friend who is an engineer building highways, and she told me that before they actually build anything, the first thing they do is look at everything that could go wrong, and they eliminate all those possibilities, or as many as they can. And only once they've done that do they actually start building. I think if you think that way about your financial plan, what's your next option? What happens if? I think the better off you're going to be. That's our second headline today. Let's say hello again to our friends hanging out with us on Facebook. Bethany says, it's always a wonderful surprise when I see Joe pop up on Facebook Live. Bethany, it's always wonderful when I see Bethany hanging out with us. Kevin asks about Radio Shack. Oh boy, you're right. You know what's funny is that I don't know that I can put Radio Shack certainly made a bunch of missteps, but I think that Radio Shack is a company that just their market went online. I mean, I remember I still bemoan the fact that there's stuff I need from Radio Shack. In fact, I would pay more for this. There's a cord right here that we're using today that's bent. And I really need a new one, and I'm not looking forward to the 2 days it's going to take me to get it from Amazon. I'd much rather just drive. It used to be like 3/4 of a mile from here. I could drive down there, get this little piece, bam, this adapter, and I was done. Adam asked about Toys R Us. Toys R Us is a whole different thing. I mean, Toys R Us, debt, number one, and number two, they gave Amazon the keys to their kingdom for online. That was tough. Sean says her local small town Sears closed 18 months ago because the owner wasn't going to renew the store lease because of this reason. Yeah. The second that leaseholders got the opportunity to rent to somebody for more money, they took it. They probably, though, Sean, offered it to Sears first, I would bet. And I'm sure Sears, because they had no money, they had to say no. Ours, by the way, did the same thing here locally, closed 2 years ago, but I think that ours was more of a national thing. Kevin says, what possible implications do you see for commercial REITs? Well, not much. I mean, for these particular commercial REITs and what Kevin's asking about, a real estate investment trust. When you buy a real estate investment trust, you want to see what they invest in, and you want to know a little bit about the portfolio. So one of my favorite REITs back in the day bought a bunch of nursing homes and assisted living facilities. That was fantastic. I also bought one, shocker, that bought theme parks. And I loved that one too. Regional theme parks at a time when gasoline was going up. The theme park one did okay. The assisted living one facility did phenomenally well. But ones that I didn't like as much were ones that own strip malls and commercial properties, because people can be fickle. I'm just not for me. I see the turnover in those, and I see half full strip malls, and I'm just never really a fan. So those didn't appeal to me. But I think when you invest in a REIT, look at the prospectus at what that, or look online to see what that REIT invests in. And if they invest in commercial properties, then maybe it's affected by Sears. But look at all of these people renting to Sears. It could be a boon for all of them, which would be fantastic. John's here with us. Lori's here. I tuned in just in time to hear Joe talk about shag carpet, tang, and lava lamps. Well, we're just talking about another day in the basement, Lori. That's what we talk about here. It's always a circus here on the show. In just a second, we're going to tie these two together. How are we going to tie a Sears closing together with, and Landlords loving it, to stock market downturns and the
dumbest headline of the week?
We're going to tie those together very simply here in just a second. But first, I want to talk about Tiller a little more, because if you're unfamiliar with Tiller, they're not only our sponsor, they're a sponsor for this show because I absolutely love them. It is 10 times faster to manage your money in a spreadsheet without data entry or multiple logins. The thing I like about Tiller is that it's customizable. I like customizing my spreadsheets down to nothing. And what's cool is Tiller gives me templates to do that. So I don't even have to do it myself. I can choose the simplest template possible. I like to move very quickly, so I like to be able to look at things on the go. Mom, on the other hand, she loves charts and graphs and being able to look at where every nickel goes and get granular. She can do the same thing. So we can customize it to be whichever way we want. Either way we do it, it's super simple because we both enjoy the convenience of seeing all our accounts updated on one spreadsheet. So whether you use Excel or Google Sheets, Tiller is for you. And by the way, if you don't like, I started with the template and then I twisted the template beyond what it was in the beginning to make it the way that I wanted. So join thousands of people who use Tiller to budget, track spending, and manage their money faster in a spreadsheet. You're going to get 30 days for free. StackyBenjamins.com/Tiller. And the way that they support the show is if you use our link, then they send us a thank you. So if you're going to do it, then definitely use our link. Adam says, I'm guessing I shouldn't apply to Sears or Kmart. For a job, Adam, probably you're a little late in the game. The spoiler is that job might not be around very long. That's so funny. Maybe should not apply to work there. All right, let's move on to the big idea for today. We do this at the end of every show. How are we going to tie together this headline about stock market volatility and Sears landlords cheering? And the big thing is this, and I referenced this at the start of today's show when we were talking about Yellowstone. We often worry about downturns in the system, and we clearly, by the way, don't want to be caught up in a downturn ourselves. And we want to learn from those. So what can we learn from Sears? We talked a little bit about that today. What can we learn? Actually, today we talk more about what we can learn from the landlords for Sears. Sure, there's a downturn. None of these people are talking negatively about it. They're talking about what they're doing next. And if you ahead of time think about what you're going to do next and have that plan in place, like my friend who builds highways, you're going to do a much better job of making non-emotional decisions. And then when it comes to market volatility, volatility is a good thing. If you're putting money in, you want the volatility. But even more than that, volatility cleans out the system. It cleans out the bad stuff. And it makes it so that the good companies actually rise. During a market downturn, you see who's ready for it and who's not. And certainly you want to be the person. But remember, downturns are only bad if you're not ready. If you're somebody that's done your work and you have your money in the right place, long-term money in long-term spots, enough short-term money to get through the downturn, you're going to come through it just fine. And like the trees that we talked about with Yellowstone, and like those pine cones that need the severe heat to come alive, it can be the same for you. That's going to do it for today, guys. Thanks for hanging out here, everybody on Facebook. Thanks for hanging out at home. This was Money in the Morning. We'll see you next time back here. Go Stacks and Benjamins. Bye-bye.
Money in the Morning is created by Saul-Sehy and comes to your ears because of the collective genius of our producer, Richie Rutter-Reese, engineer, Caden Thompson, and a pack of very well-trained ferrets here in the basement. You'll find links to all of our headlines featured on today's show in Joe's Twitter feed at @AverageJoeMoney. I know you already know this too, but Money in the Morning is for entertainment purposes only, and you shouldn't act on anything recommended by a bunch of entertainers in a basement without first consulting with your financial advisor and second, having your head examined. Have a headline you'd like us to discuss? Send them to Joe at stackingbenjamins.com or put them on our Stacking Benjamins Basement closed Facebook group. This show is copyright 2018 Stacking Benjamins LLC, all rights reserved. I'm Joe's mom's neighbor, Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.